Okay, so the obvious question that some of you most likely have is, why am I losing money? Now, again, I've produced longer videos on distribution risk and the mechanics, so I encourage you to watch those. But for the sake of this tutorial, you are losing money because these dividends and these distributions are a component of the price when you bought it. That is, that when you buy that S&P 500 fund, you're not just buying the S&P 500 stocks. You're also buying the income that was earned by that fund before you bought it. The income that was earned from the dividends and the interest that was paid from the securities that these fund holds, it goes and it gets attached to the value of the security. So you're buying the S&P 500 fund, plus you're buying these accrued but unpaid distributions, dividends, capital gains, interest, etc., etc. Okay, so part of your money is going towards buying these distributions. Then, when that distribution is made, the amount of money that went to buying the distribution is returned to you. This is a return of your money. So in this example here, $6,400 of your money went towards buying the SPY's accrued but unpaid dividends, etc. That $6,400 is going to come back to you when this dividend is ultimately paid. That is a return of your money and should not be taxable. Here's what this is like. If I have $1,000 and I put it in the bank, I deposit it. Then a week later, I go to the ATM, I take my $1,000 back out. The $1,000 that I just got from the ATM, is that taxable income to me? Well, no. I'm getting my own money back. I'm no richer, right? I haven't earned an additional $1,000. I put $1,000 in the bank. I took $1,000 out. Here, same thing is happening. You put $6,400 in this fund. The fund manager held on to it for a week or two, and then he paid you your $6,000 back in addition to a drop in the security price, right? The problem is that the accounting systems used by Wall Street do not account for this return of capital distribution. This income that you put in the fund and that the fund sent back to you, that money is fully taxable. So what we're doing is we're taking the amount of money that represents a return of your capital and we're multiplying it by the tax rate, right? Because you shouldn't have to pay this tax because there was no income. However, it's fully taxable, according to the way that all the asset managers and brokers and so forth, according to the way they do this, that income, they know it's a return of your capital, but they're going to tax it anyway. Therefore, every time you buy one of these income producing securities and you receive any form of distribution, a dividend, a short-term capital gain, a long-term capital gain, etc., you are going to be paying taxes that you do not legally owe. Now, we can get into this later. It's not part of the tutorial. Many of you are probably wondering what RoboTax is here and why there's a zero. It's because FairShares produced software called RoboTax. RoboTax can be used by your brokers and custodians and asset managers to essentially do these calculations on every transaction you make, claim these deductions so that you don't lose money. It's a very, very simple end-of-year tax process, and any fiduciary, which pretty much every firm on Wall Street has some fiduciary duty when it involves money, these fiduciaries have a legal right to provide every investor with accurate taxation and absolutely protect them from losing money. Okay, so why am I losing money? You are losing money because every time you make a trade in an income producing security, part of your money is going to buying this distribution. It's a tax liability. It's a tax liability that's being attached to the security. As soon as you buy the security, you now own this tax liability. This tax liability is going to be passed back to you. This is a return of your own money and should not be taxable, but Wall Street is taxing these distributions fully, which creates tax losses. If you're going to levy an income tax on something, you have to prove that there's income. In this case, there's no income, and there isn't an accountant out there that will dispute this fact. It's called buying a dividend. Once again, thank you so much for watching this tutorial. I hope that this made sense. We have other videos. I encourage you to watch them. Also, please subscribe to our YouTube channel and ring the bell so that you can be notified when we post more stuff. You can also follow us on Twitter at FairShares Inc. Thank you so much, and on to the next video.